Over the past year or so, we've seen a lot of negative real estate news coming out of markets in Florida, Texas, Arizona, as well as California and Colorado, in addition to lots of other places throughout the Sun Belt. And mortgage rates for 30-year mortgages are now at around 7%. This is not the all-time high. We had a over 7% just a couple of years ago, but it's getting back up to where the highs were previously. In addition to that, we're seeing a lot of negative news coming from Zillow and Redfin. And the question is, have real estate prices peaked? Are we past the peak of real estate for this cycle? Now, the last time we had a housing bubble was 2006 to 2008, and that's 16 to 19 years ago now. And since that time, since the depths of the housing, the the bust of the housing bubble, probably around 2012, 2011, 2012, prices have gone up every year except for a small blip during the COVID pandemic. Since then, we've had positive housing prices, and some of these increases in certain markets have been incredibly rapid. But before we look at some of the data, I want to show you a clip of what Redfin CEO Glenn Kelman had to say on CNBC.
What is the overall market telling you just in terms of demand? I get that it's competitive and the new builders are competing, but what does demand overall look like with mortgage rates back at 7%?
There has been a real shift. So home buyers over the past few years shook off rate increases. Home prices kept rising. We anticipate that prices will fall at least 1% in the second half of 2025. And when you compare that to 4% wage growth, it means that finally home buyers may be in a position to catch a break. But it has been very hard to put deals together over the past few months. And that is because sellers still have higher expectations from previous years, and the buyers are now standing back. Some of that is macroeconomic anxiety. 1 in 4 Americans right now say they are canceling or deferring plans to buy a car or a house because they're so worried about the economy. But we are seeing finally evidence of a real correction where prices are going to come down.
Glenn, do you think that if the labor market weakens substantially, people feel like they have to move, mobility increases because their search for a job has to widen? Does that actually end up being good for sellers?
I don't think that a weakening labor market is good for anyone.
Yeah.
So people will always move for jobs. Right now, the only people who are really moving at 4 million existing home sales a year are the folks who have to. So it's death and divorce and other major life events. Opportunistic movers are headed for the hills. So right now, we just need a really stable economy. We need things to settle down. When the stock market goes crazy, people in coastal markets can't afford a down payment. When folks start worrying about their jobs or about prices, they put off big ticket purchases. So there really isn't a universe where I would imagine that uncertainty in the labor market would help the housing market.
There you have it from Redfin CEO. They're expecting a correction to begin. And the thing is, with real estate corrections, they usually last a number of years. The previous housing bust basically lasted about 5 years. So real estate corrections tend to last quite a long time. The other thing is, he mentioned a 1% decline. Now, that doesn't sound like a lot because he's speaking about national statistics. And you have to take into account when it comes to nationally, there are a lot of housing markets around the country that are very quiet and haven't moved, haven't had any appreciation at all. Where this really tends to impact are the housing markets that have had a lot of appreciation over the past few years. And there are quite a few throughout the Sun Belt, especially Florida, especially Texas, Arizona, but even Georgia, North Carolina, Tennessee, places like Nashville as well, and Colorado and California. So quite a few places. Now, there are quite a few areas of the Rust Belt up around the Great Lakes that haven't had appreciation. In fact, a lot of them have been depreciating for years or even decades. So some of those areas aren't going to see the same kinds of declines as you might get where there's been in other markets where there's been rapid appreciation. Now, one of the other things I wanted to do is I wanted to read to you just a quote from Zillow's latest forecast, in which they've changed it. Home values are projected to fall by 1.4% this year, revised up from the previous 1.9% decrease. The combination of rising inventory due in part to soft sales volume so far this spring could continue to put downward pressure on home values. So there you have it from Zillow as well. They're projecting a decrease of 1.4% nationally this year. The thing I wanted to show you is a chart of where mortgage rates have been and where they are. Now we're almost at 7%. This is a max chart from the Federal Reserve, and it charts all the way back to the 1970s. But here we are. The last date on here looks like May 8th, 2025, and it's 6.76%. This is for 30-year fixed rates. Now, just a couple of years ago, here we are in 2022, 2023, it was well above 7. It had since decreased, but prices, mortgage rates are on their way up. Now, if you look at that previously, for years we had much lower rates. They only started going up after the pandemic or near the end of the pandemic when we really started to get inflation. But we previously, for more than a decade and a half before that, we'd had declining rates, actually 2 decades before that. And if you look in here, these are the years between 2000, 2005 that really blew up the housing bubble. We had declining rates. And then, of course, it blew up 2000. Things peaked in Florida around 2006, summer of 2006. And then they declined all the way till 2010, 2011, 2012. But through that time, we had declining rates. And these low interest rates made it possible for people to get back into the real estate market. Even though prices had crashed, we still had very low rates, so it allowed people to have lower payments on the houses that they were buying. And that is a phenomenon that stayed with us for a decade and a half after the housing crisis, housing price crisis, price bubble, whatever you want to call it. But here we are now, and we're back at higher rates again, and prices are unaffordable for a lot of the country. So I just wanted to show you that, and I'll just show you a quick flash of mortgage rates today. Mortgage rates from Mortgage News Daily, and 30-year fixed is at 702, 15-year fixed 6.3, and a 30-year jumbo at 7.13. Anyway, those are the current rates today. For a long-term view of the U.S. housing market. This goes from 1963 to 2025, and it is median sales price of houses sold in the United States. As you can see, we start out here in 1963, and here we are today. And if you look back to the fourth quarter of 2022, the median price is $442,600. Since then, we've declined, and we're at $416,900 in Q1 of 2025. So it looks like prices may have peaked in the fourth quarter nationally in 2022. Now there has been positive news around the country since then, and as well as a lot of the negative news. But going forward, we have a lot of negative news, and we already have a lot of prices, downward pressure on prices across the vast majority of markets in the United States. And so we are actually having negative prices in the United States. Now, if you look at the previous housing bubble, first of all, look where we've come since 2020. Prices have really exploded upwards. They've gone from, at the beginning of 2020, 329,000 to that high of 442,000. Now previously, this was our previous housing bubble right here. Q1 of 2007, 257,400. That's the peak right there. That's the peak of the housing bubble. This thing we called the housing bubble. It looks like a speed bump compared to where we are now. So I really think this is the most interesting chart And housing is unaffordable for a lot of Americans now, and it really seems like we may be in for something very similar to what happened at the beginning of the housing crisis in 2008. This is the recession right here. And this is what happened to housing. Wanted to show you is the monthly supply of new houses in the United States. And this is a chart that also goes back to 1963. Just to show you right here, we had this massive spike of new housing in the last downturn of inventory. And here we are today. This is the COVID spike right here, so there was a bit of a spike there that went down very quickly. And that was just due to the unknowns in the market due to COVID. Nobody knew what was going to happen. But here we are. We've been growing inventory for the past few years. This is also something that would lead to lower prices, is the growing amount of inventory. And if you look at the previous crisis, the inventory didn't actually explode until after we were already in recession. And that was quite a bit after the initial kind of market crashes were happening, say in 2007. 2006 it happened in Florida, so back here in Florida, the inventory wasn't nearly what it was 2 years later, 2008. So there's that chart. That's an overall view of the real estate market as it stands nationally right now. Now, the question is, where is it going to go? I think real estate rates, mortgage rates are going to be going up and prices are going to be going down. And that's based on how far we've come in a lot of markets. Now, this is nationally, it's also what a lot of experts are saying. Anyway, let me know what you think about this. Where do you think real estate's going nationally? Or where do you think it's going in your market? If you like content like this video, please give it a like. And if you'd like to see more content like this in the future, please subscribe to my channel. Thank you. Until next time.